Welcome to the deep dive. Today we're really getting into the details of Aptus Value Housing Finance India Ltd.
That's right.
What's quite interesting about them is their specific focus. They're all about providing home loans to first-time buyers, mostly folks with lower incomes, and primarily in those semi-urban areas.
Mm-hmm. A very defined niche.
Exactly. And for this deep dive, we've got our hands on their latest investor presentation that covers Q4 and the full financial year ending March 2025. Plus, we've got two pretty fresh research reports.
From Axis Securities and Centrum Broking, both dated around May 7th or 8th, 2025, so very current.
Right. So our mission today is basically to sift through all this data, pull out the key insights for you on how Aptus is doing, what their core strengths are, and what the future might hold for them.
Sounds good. Let's jump in.
Okay.
So to really get Aptus, it helps to know where they came from. They kicked off back in 2010.
Okay, so they've been around a bit.
Yeah, now in their 16th year. And what's really core to them is that customer profile you mentioned. First-time homebuyers, earning under, say, 50,000 rupees a month. Often self-employed, living in those Tier 2, Tier 3 towns.
So a segment that maybe bigger players don't always prioritize.
Precisely. A large demographic, potentially underserved.
And they've built up quite an operation to reach them.
They certainly have. We're talking about 300 branches spread across 6 states and 1 union territory.
Wow, okay.
And their whole pitch, their value proposition, it revolves around access making loans available, but also speed, transparency, and decent service.
Which must be crucial for that customer base.
Absolutely. And internally, they really stress good governance and making sure management's interests are aligned with the company's success.
Okay, so focused model, solid operational base. When Aptus themselves talk about strengths, what are the big headlines?
Well, number one, they point to their profitability. Specifically, that return on equity, the ROE. It's sitting at 18.8%.
Which is quite healthy.
Very healthy. It basically shows how well they're using shareholder money to make profits. They also really hammer home that they operate in a large, underpenetrated market.
Meaning lots of room still to grow.
Exactly. Lots of potential customers out there in their target group. Then there's asset quality, basically how likely their borrowers are to pay back. They see that as a strength.
Always critical for a lender.
And they also have a diversified income stream. It's not just home loans or HL. They also do small business loans, SBL. That mix helps.
A bit of risk diversification there.
Yeah.
And geographically, they're not standing still.
No, definitely expanding. They've made strategic moves into Maharashtra and Odisha, added 10 new branches just in those states last year.
Right.
And the other big piece is technology. They have this mobile-first, fully digital loan origination system, LOS, they call it.
Right, I saw that mentioned.
Yeah, it even uses AI and machine learning for the credit scoring side of things.
That feels like a potential edge, especially in reaching those semi-urban areas efficiently. And they've picked up some awards, too.
They have. Recognition from places like Dun & Bradstreet, Financial Express, Deloitte. It all helps build credibility,
Definitely adds to the story. Okay, let's get into the numbers then. The financial performance for FY25 looks, well, pretty strong on the surface.
It really does. Let's start with AUM, assets under management. That's the total loan book value. It hit ours 10,865 crores.
Which is a big jump, right?
Yeah, 25% growth year on year. And they crossed some key milestones, over 10,000 crores in AUM and serving more than 1.6 lakh customers now.
Okay.
And if you look back 5 years, their AUM has grown at a compound annual growth rate, a CAGR, of 28%. That's consistent, strong growth.
That consistency is key. What about the customer count itself?
Also growing nicely, they reached 161,597 customers, which is up 21% from the previous year. Shows they're effectively onboarding their target clients.
And the actual loans going out the door, disbursements?
Disbursements were up too. Ours 3,604 crores in FY25. That's a 15% increase year on year. Suggests continued demand.
And that flowed through to income.
It does. Total income hit ours 1,799 crores, up 28%.
So strong top-line growth. How did that translate to the bottom line, the profit?
Profit after tax, or PAT, came in at Rs 751 crores. That's a solid 23% growth year on year. And as we mentioned, that ROE was 18.8%.
Very healthy.
Now, net interest margin, or NE, this is where it gets a bit nuanced.
Okay.
Aptus's own presentation calculates it at 13.0%. But if you look at the analyst reports, Axis Securities calculates it at 8.7% for Q4, and Centrum Broking has it at 12.0% on average earning assets for the quarter.
That's quite a difference. Why the variation?
It mostly comes down to the calculation methodology. The company might use total assets, while analysts often use average earning assets, which can give a different result. It's just important to be aware that different calculations exist.
Right, context matters when comparing those figures. Okay, crucial question for any lender.
Yeah.
Asset quality. How are their loans performing?
Pretty well, based on the numbers. Gross non-performing assets, GNPA, stood at 1.19%. And net NPAs after provisions were even lower at Borden 0.89%. These are generally considered good numbers, suggesting most borrowers are paying on time.
And their safety buffer. Capital adequacy.
Extremely strong. Capital adequacy ratio, CRAR, was 70.0%. That's a huge buffer against potential losses.
Very reassuring.
And Axis Securities also noted their cost-to-income ratio was around 20.2%, which points to pretty efficient operations.
Okay, so strong financials, good asset quality. How are they planning to keep this momentum going? What are the growth strategies?
Well, geographic expansion is definitely one, pushing deeper into existing markets, but also that move into Maharashtra and Odisha. They plan about 40 new branches overall in FY26.
Ambitious.
And importantly, they say the credit behavior in these newer areas is looking good so far. Another focus is productivity.
How so?
They want to nudge up the average ticket size, the ATS, of their loans, moving from around 8.5 lakhs towards 9 to 9.5 lakhs, plus making their loan officers more efficient. And then there's the digital transformation piece we touched on, leveraging that mobile LOS for everything onboarding, AML, credit checks, collection.
And the adoption rates sound high.
Very high, like 96% digital agreements, 96% digital collections in Q4. It's clearly embedded in how they operate.
It seems like technology is really core, not just an add-on.
Absolutely. And their customer focus remains sharp, self-employed, lower middle income, tier 234 cities. Plus, that diversified portfolio, mostly home loans, 71%, but also quasi-home loans, SBLs, others, that provides some balance.
Right, so multiple levers for growth. Now, managing asset quality in this segment must be tricky. How do they approach it?
They talk about rigorous in-house sourcing, finding the customers themselves, and centralized underwriting. Control from the start.
Makes sense.
Plus a robust collections management system. And they're consistent with provisions. Their provision coverage ratio, the PCR, on stage 3 assets, the more stressed loans, is steady at around 25%.
So setting aside a quarter of the value of those stressed loans.
Exactly. And overall expected credit loss, or ECL, cover is about 1.03% of the portfolio. Axis also gave some delinquency figures, 1+ day past due at 7.5%, 30+ days past due at 5.9% in Q4.
Okay, provide some granularity there. Let's talk funding. Where does the money come from, and how stable is their financial footing?
They've got a pretty diverse funding base, relationships with over 25 lenders banks, the National Housing Bank, NCDs.
Good mix.
And importantly, no exposure to short-term commercial paper, which can be riskier. Liquidity looks comfortable too. They have about 1,529 crores surplus, enough for business needs up to September 2025, they say.
It's a decent runway.
And here's an interesting point. About 80% of their loan portfolio is fixed rate.
So if interest rates fall.
Exactly.
Yeah.
It could potentially boost their net interest margins as their borrowing costs might fall while their lending income stays fixed for a large portion of the book.
That's a potentially significant advantage in the current macro environment. Okay, what are the analysts saying? Axis and Centrum seem positive.
Yes, definitely positive. Both have BUI recommendations. Axis Securities set a target price of RS 400.
Suggesting what kind of upside?
About 25% upside from the price when they wrote the report. They expect continued strong growth delivery and think margins will benefit from any rate cuts. They're forecasting around 27% CAGR in AUM, NII, and earnings through FY27.
And row.
They expect those to remain best-in-class ROA around 7.2, 7.3%, and ROE between 20-23% over the next couple of years.
That's a strong forecast. What about Centrum Broking?
Also a BUI rating. They've revised their target price upwards to RS 457.
Wow, that implies even more upside.
Yeah, about 44% upside. They also highlight the best-in-class returns and expect continued strong growth and profitability. Their CGR projections for AUM, PPOP, and KI are similar, around 25-26% over FY25, FY27.
And they also mentioned the fixed rate book.
They did. They see that as a clear positive in a potential falling rate scenario. They project ROA reaching 7.2% and ROE 21.6% by FY27.
So, strong consensus from the analysts we have here, but no investment is without risk. What did Axis flag as potential concerns?
Two main things. First, just a general risk of a slowdown. If disbursement or AUM growth doesn't meet expectations, that would impact earnings.
Sure, the macro environment matters.
Right. The second is an increase in BT out rates, balance transfer out. That's when customers take their loan elsewhere, maybe for a better rate.
Competition, essential.
Exactly. Axis notes these rates seem manageable for Aptus currently, but it's something to watch. If competition heats up significantly, it could become a pressure point.
Good points to keep in mind. And briefly, on corporate governance. Aptus seem to emphasize this.
They do. They point to a clean track record, no defaults, no audit issues, no financial restatements. They highlight their experienced board, dedicated chief risk officer, chief compliance officer.
Standard good practice, but important.
Yes. And they also talk about their broader impact, financial inclusion, creating jobs in semi-urban areas, women empowerment through their loans, those ESG type
Good to
factors.
see that mentioned. Okay, so let's try and wrap this up. What are the key takeaways?
Well, I think Aptus Value Housing Finance really demonstrates strong performance within its specific niche. You see robust financials, significant growth, pretty healthy asset quality, especially considering their target customer.
Yeah, that focus seems key.
It does, and their digital initiatives, the geographic expansion, efficient operations, it all seems to position them well for continued growth. The analysts clearly agree.
And that fixed-rate loan book is a potential kicker if rates do fall.
Definitely a point in their favor right now.
So a really interesting picture overall, and perhaps a final thought for you, our listener. Think about how Aptus has built this success by really honing in on a specific market segment, the self-employed lower-income homebuyer. And consider how critical their use of technology seems to be in serving that segment effectively. Looking ahead, what wider trends in India's economy or in the financial sector itself do you think might shape their path forward? Something to mull over.
Definitely. Thanks for tuning in.
Thanks for joining us for this deep dive.